depreciation. And that was for 40,000 for D. 40,000. So manufacturing overhead again, depreciation. And accumulated depreciation. Okay, other manufacturing overhead costs incurred during October were 70,000, credit accounts payable. So this is for letter E, so manufacturing overhead and accounts payable will be 70,000. 70,000 here and 70,000 accounts payable. Okay, so now F, the company applies manufacturing overhead costs to production on the basis of $8 per machine hour. A total of 30,000 machine hours were recorded for October. So this $8 is our predetermined overhead rate, and we actually incurred 30,000 machine hours. So if we take our predetermined overhead rate, $8 times it by 30,000 hours, actual hours, that'll give us the total amount they applied. So these are actually what they incurred for manufacturing overhead. Now we're going to compare that to the amount that they applied. So we know that they applied $240,000 right there, $240,000, and we'll see how much we actually incurred during the period. So we incurred $232,000 and we applied. So when we apply it, that means we're going to be taking out, we're going to be moving manufacturing overhead to work in process, this applied overhead, right? We always do the applied to work in process and not the actual, just because this is our estimate and we need an estimate at the beginning of the period to use or during the period to use. So our journal entry will debit our work in process for the applied manufacturing overhead and credit our manufacturing overhead. This applied amount, that's 240,000. 240,000, 240,000. So we have a debit here, 240,000. So now we have our beginning, our direct materials, direct labor, applied manufacturing overhead, and then we will credit out our ending work in process. And then, so this is our journal entry right here. And so when we look at our actual versus applied, we can see if this is going to be over applied or under applied. And so we probably overestimated our predetermined overhead rate, and so now we have over applied the amount. So if we take a difference of this minus this amount, we've over applied the amount of money for manufacturing overhead. And so now we can look at our work in process and sum that up. And we'll see how much we have in work in process as a balance. And so $550,000 in work in process. And so on number G, it says production orders costing $520,000 according to their job cost sheet were completed during October and transferred to finished goods. And so almost all of this was completed. So these products were completed, and so $520,000 was completed and moved to finished goods because they were completed. So that journal entry will be finished goods inventory and a credit to work in process because it's finished, 520,000. So we'll still have a balance in the work in process that's not completed. And then H says production orders that have a cost of $480,000 to complete according to their job cost sheets were shipped to customers during the month. These goods were sold on account at 25% above cost. And so we have this amount of inventory, and then they sold $480,000 worth of it. So we know that when we're selling inventory, there's 4 parts to the journal entry. So we're selling this inventory and we're getting, I think we're getting an accounts receivable, and we are getting sales revenue. and it's costing us our cost of goods sold, and we will credit our finished good inventory because this is our expense, and then that's how much it'll cost us. So they said it was going to cost us $480,000, and then they said they sold it at 25% above cost. So we'll do this one times it by 100%, which is, you know, exactly the same, plus the extra 25% above cost. So they sold it for $600,000. And so our journal entries would look like we're taking this out of cost of goods sold. We're taking it out of finished goods, and we're putting into cost of goods sold, $480,000. Debit here, or this entry right here is what I just did. And then we have accounts receivable, money coming in soon, and then sales revenue of $600,000. Okay, so we've done all of the journal entries, and then you can calculate the balance. So as we see over here, this one minus this one, we have a balance of $8,000. Over here, it looks like a balance of $20,000. Over here, balance of $30,000. This one minus this one. And you can do this and so forth. You can do this. But really we want to look at this actual versus applied. So we over applied by 8,000. So if you saw that on the exam, you would say we would over applied by 8,000. If they didn't give you any of this and they just gave you the actual and they gave you the amount that was over applied, you could solve for the amount that was that they actually applied. You could work backwards. And then since this is over applied, that means that we were valuing our cost of goods sold too high. So it really didn't cost us the $240,000 over here. It costed us $232,000. So since we over costed or over expensed our inventory, our cost of goods sold will be lower, this $8,000 lower. We won't adjust the finished goods, we'll only adjust it when we sell it, this cost of goods sold. And so our net operating income will be higher, or our net income will be higher because we were overvaluing or over expensing the amount that this inventory was costing us. And so you would close out this account or zero out this account with a debit of $8,000 and a credit to cost of goods sold. And so your cost of goods sold would really only cost you about $472,000. And even though they didn't sell all of this inventory, in order to be more simple and because they sold the majority of the inventory, it's reasonable to close out this manufacturing overhead or zero it out with a debit over here. So it'd be like a debit to manufacturing overhead, this $8,000 over here, and a credit to cost of goods sold. So remember, I'm crediting cost of goods sold and not finished goods. Only when it's sold will I account for this. I will account for this $8,000 to zero out the account. And that will make, since our cost of goods sold went down, our net operating income or net income went up. And so that was $8,000. So hopefully this makes sense to you as you go through it. The journal entries will start to flow and you'll be able to see the whole process of what we're doing here.